Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. China's factory activity expanding for a third month in December, boosting expectations the economy will reach its annual growth target after Beijing's stimulus blitz. Stocks in Hong Kong set to end 2025 on a positive note, but mainland equities still struggling for traction. The Bloomberg Dollar Index closing out its best year since 2015. We'll dig into the outlook for global markets next year with Zuma Wealth CIO Terri Spath. Find out why she favors energy, financials, and consumer staples. And we get a read on India's economy in 2025 with Emkay Global's Madhavi Arora, who's worried about what she calls a not too exciting consumption story. And just like that, it's the final trading day of the year, and 2024 has been about the Fed and interest rates around the world. Remember, we kicked off the year expecting 7 rate cuts by the Fed. We ended with 4, and inflation remains sticky. We're looking possibly at 2 rate cuts next year, some say. It's also been about that strong dollar story, putting a lot of pressure on Asian currencies, in particular the likes of the rupee, the rupiah, also the Korean won, the greenback posting its best year in nearly a decade. It is up against all G10 currencies. So what a ride it's been for the USD. Let's get more on markets with Terri Spath, founder and CIO of Zuma Wealth. Also joining our discussion is Paul Dobson, Bloomberg's executive editor for Asia markets. Terri, let's start with you. I mean, we've had so many guests in the seat in the studio saying that if you want to continue to make money, it is about U.S. exceptionalism, even in 2025. Overweight the U.S., overweight the dollar, overweight Mag 7.
Well, that is kind of the consensus view right now, is what's worked in the past, 12 months, 24 months. Let's continue to do that going forward. But I think to put some context and to put some boundaries around that, when we look at the U.S. stock market, we've got strong expectations for sales growth, strong expectations for earnings growth, and that, translates into strong stock prices. The risk of that, of course, is valuation. We do think that valuation's gotten stretched in certain parts of the market. But in terms of U.S. stocks doing well on a relative basis, if you want to call it exceptionalism, I guess that's one way to look at it. But we also, in all seriousness, do see some relatively better growth opportunities here in the U.S. and internationally. And so we do think that will help U.S. stocks and U.S. stock investors going forward.
Terri, you talked about valuations. Very interesting, right? I mean, some say that it's really sky high right now. If you take a look at 12-month forward earnings, they're at, 90% percentile as we get into 2025. You got to imagine, you got to question, if we're looking for further upside in U.S. stocks, I mean, how much more upside are we looking at? What's the possibility of that?
Right. Yeah. I mean, I do think you have to pay attention to valuation. I'm a classically trained investor, and I can't help but look at valuations, and they're stretched right now. U.S. stocks are expensive, as you pointed out. For the most part, top 10% valuations in terms of if we're looking at forward PE ratios today versus historically. Where are we on the map? Well, we're the top 10%, meaning the most 10% expensive. That's not great. That means that that's a risk, and that's something that we're paying attention to. The bar is high. For tech stocks and also for U.S. stocks, as we talked about, with strong earnings and strong sales growth, we expect those valuations to be supported, but we are paying attention to the risk that valuation can pose to what the total return can be for stocks. So we've had a really strong 2024. That was on top of a really strong 2023. We don't expect it to be as strong in 2025. I don't think really anybody is. But we do think that we can see high single-digit growth throughout the course of the next 12 months. We do think that 12 months from now we'll be at higher levels than we are at today, and that stocks could have the potential to grow into some of those valuations that we're talking about.
Paul, the bar is high, but the catalysts are there. We're talking Trump, right? Deregulation, taxes are meant to be cut. And of course, policies which favor the U.S. Make America great again, America first policy. These are all policies that will favor the U.S. Stocks.
That's right. And I think that's why investors all around the world are still looking to the U.S. as a place to park their money. That plus the idea that the dollar will continue to appreciate, all things being equal, under such a policy mix as well, particularly if it means that the Fed is less minded to continue to cut interest rates. So you have those inflows coming around from the rest of the world. You have U.S. investors thinking, well, we're happy to keep our money parked here as well. Why would we look elsewhere? People often, of course, go by past performance and think that that can continue, even if history tells us that it's probably better to at some point jump off the moving train before it runs out of fuel or momentum and that kind of thing. I think, for all that, January is going to be bumpy, right? Trump is going to be inaugurated. We don't know exactly what the policies are going to look like. There's a lot of risk out there at the moment.
We have a sense of those policies, though.
A sense, yes. But, is it a negotiating position? Is it a bargaining position? Are we really going to see mass deportations in the second half of February? Are we really going to see across-the-board tariffs coming into play right away? Are some places going to get targeted more than others? And how does that really blow back to the U.S. Stock market and the U.S. economy? Is it going to push up those Treasury yields? Is it going to cause more volatility, and actually that sort of, triggering a risk-off kind of vibe could do? On the other hand, like you said, if the policies are all favorable for U.S. markets, for U.S. investors, for U.S. stocks, then it could really be another catalyst for us to see some further momentum and gains into the start of next year.
And Terry, of course, we had Paul talking about Treasury yields. I mean, yields have been in focus. Some say perhaps they're going to trend even higher next year. What are your thoughts on that? And what do you do with bonds? Some say, you know what? Given 2025, it will be a year for stocks again. Dump those Treasuries.
Those Treasuries. Yeah, it's been a tough year for bonds. For the second you bring up, that's how most people feel about a lot of bonds right now. I mean, it was a terrible year for bonds a couple of years ago. It wasn't a great year again this year. Before I get to that, I do want to tag on a little bit to Paul's comment that I do think that investors should take Trump's comments about tariffs seriously, but not literally. What I mean by that is, I think he's serious about increasing tariffs, and I don't think we should discount that. But I don't think the literal numbers and some of the big, giant numbers that have been thrown out and a lot of the bluster, I don't think that is something that we want to take seriously. Or I should say, we don't want to take them at face value. Tariffs, aggressive protectionism, those are serious threats, but we don't think that the numbers that have been kind of thrown out are necessarily going to be the case. That said, we do think that there's a risk for inflation in 2025. That's a little bit higher and hotter than people had been expecting if, a different administration or a different mix of Congress had come into place. We do think that it's a warm inflationary environment, and that will probably continue to be the case. So yields will probably be a little bit higher than maybe the people thought even 6 months ago. But one way to play that, if you don't want to be in some treasuries, or if you want to throw those out, is high yield corporate bonds are actually quite interesting right now. We think high yield corporate bonds that, it's a safe economic environment. We do think that the default risks are pretty low. The yields are high. The income is good. And so that's one way to kind of round out that bond part of your portfolio to make sure that you get some yield and some total return if treasuries aren't doing it for you.
And they say, Paul, if you want to make money too, tech is the way to go. And you know what? We have that bromance between Trump and Elon Musk, and that can only be good for tech stocks.
Yeah, well, you hope so, or you think so, especially if you're long. Yeah, until those valuations, as Terry was talking about, get so stretched that people start to lose their appetite for it. Or, we have one bad earnings, and that really sort of upsets the momentum that we've seen. I mean, there's been the unstoppable growth that NVIDIA in particular has seen, but some of the other US Magnificent Seven companies too. It's just a question of, do you want to continue to be the last person sort of coming in or building further positions as the market starts to top out. And like you say, at some point there will be a setback because it can't carry on going readily for forever. There are things that could upset that momentum. Maybe we get an energy price shock that could be potentially damaging. Maybe more competition comes. I think what's going to be interesting is, from an Asia perspective, maybe how does that strength within the US companies transfer to the rest of the world, or how does the rest of the world respond? Is it going to start being a bit more aggressive in pushback there? Are we going to see national champions emerging in Europe, in Asia as well, that can be rivals and that can show that same sort of growth that we've already seen within the US market? If you can find some of those Chinese names, for example, that are going to be much more in favor as there's a shift towards domestic production of tech equipment and technology growth in general, then maybe that's a more exciting area to be in than these more mature US markets that have already seen such dramatic gains recently.
So not to mention some of these Chinese stocks are also trading at a discount. Paul, hang tight. Terri Spath of Zuma Wealth and Bloomberg's own Paul Dobson will be sticking around. Coming up later this hour, we turn our focus to India and the growth outlook for the coming year, plus the challenges facing a new central bank chief. We'll discuss all that with Emkay Global's chief economist, Madhavi Arora. Plus, India's Adani Group ringing the changes, planning a $2 billion exit from a consumer joint venture while replacing its green energy chief. All those details coming up. Keep it here with us. This is Bloomberg. Welcome back. China's factory activity expanded for a third straight month in December. The official manufacturing PMI came in at 50.1, indicating a slightly slower pace of growth than economists expected. The non-manufacturing measure of activity in services and construction was 52.2, significantly above estimates. Let's dive deeper into China with Terri Spath, founder and CIO of Zuma Wealth, and Paul Dobson, Bloomberg's executive editor for Asia markets. Terri, signs of stabilization. The question really is whether that's enough.
But that's enough to put money back into China. I mean, we've been very negative on China for a while. We've been pretty loud and clear that we're a hard no when it comes to investing in China, at least for our clients. And the reason for that, albeit those are, nice numbers that you just put on the screen, they are good. But China has its own problems that are preventing that country from going back to high growth. They've really overdone it in real estate. China is sitting on 100 million empty houses, and tons of non-performing loans in the banking system. The banking system is undercapitalized. All that is preventing China from going back to a high growth mode. On top of that, the population growth just can't support what's necessary to grow back into those problems. So we think that this is a problem for China that's not going away soon, and we're not at all exposed to anything in China right now. It's a hard no, as I said.
But you got to wonder whether, Terri, China could be a good diversification story. I mean, it could surprise on the upside in 2025, given, the stimulus and, the aggressive nature in which the government wants to reverse sentiment.
I think you raise a good point there. And I do think as potential stimulus does become clearer, China's role in the commodities landscape might be interesting and important to watch. We do think it could be a little bit risky as we wait until March, which is probably when we'll get information as to when there's some fresh fiscal stimulus in China. We don't know if we'll get anything before that. But what is a possibility, we think it's a low probability, but it is a real possibility, is looking in 2025 as the scale of China's fiscal stimulus could result in a super cycle for commodities, and that also could get a tailwind from the strength in the tech cycle, these need for data centers that are exploding around the world with this increase in AI. That could possibly make parts of China, and particularly the commodities cycle, a nice plus that you could have as part of your portfolio for 2025.
The thing about China, Paul, is that there is a huge room for disappointment, and we're seeing disappointment again and again in 2024.
Yeah, and people have gotten used to that as well. I think it's very interesting. Terri says a hard no on China, and I think that that's the perspective of a lot of international investors at the moment, because they see, every time the market gets excited, if you really quick, maybe you can catch that 20% rally that we have in stocks, over a few days. But if you're not there right on the right and then get that timing exactly perfect, then the prospect for that longer term steady gains that we're seeing in other markets around the world just hasn't really materialized. And there are so many risks, like you say, so many opportunities that China has had to fix it in a more complete way that it's deliberately turned away from, that the market isn't expecting that kind of big bang moment anymore and isn't satisfied with the piecemeal stimulus that we're getting through as a result. And I think that the key really is that international investors steering clear means there's a large chunk of cash that's gone and isn't coming back to China. We see pension funds reducing their allocation by half, people following emerging markets moving into ex-China indexes, disinterest, risk, political risk, geopolitical risk, Trump risks, or too many clouds hanging over the market for people to have that confidence, and also domestically too little confidence in the consumer outlook and in the outlook for the economy as well. So that's really making it, it makes it easy for there to be a positive surprise, like you're saying, Haslinda, but on the other hand, it really sort of shows that you need to do something pretty terrific to overcome that negative mindset.
It's not just about the stimulus, it's also how stimulus is being deployed. Terri, what would it take for you to change your mind about investing in China? I mean, we're talking about China right now without even knowing what Trump has in store for China next year.
Right, and we haven't even touched on that. I have to say, listening to Paul talk about all the negatives of China, there's a part of me that's like, ooh, that makes it's all sounding interesting, because when things are that hated, right, it does make it like, oh, maybe I want to be the one that get in there, and I do think that at some point things get so beat up enough and so hated enough that it's just so disliked and so discarded that there are opportunities for, a medium and longer term time frame. That said, there's nothing that besides that to make China interesting right now. It's perhaps, this potential upcycle in commodities, because the thing we haven't even talked about that you just raised is, these hard tariffs that are going to be coming out of D.C. with a target focused right on China. That's going to add to the problems for that country and for the possibilities for it to just sort of grow out of the problems that it's facing right now. So that's where we stand on that.
So, Terri, I'm interested to know if China isn't the ideal place as a diversifier for your customers, for your clients, outside of the US and beyond the US markets and the strength that we were talking about there. Where else are you looking for opportunities around the world at the moment?
Yeah, well, I'm glad you asked that, because there is. I don't want investors to come away from this and think that our point of view is that we only want to, be very U.S. centric and centric on a couple few industries, because that's not the case. I think it does, of course, make sense to have diversification, but to do it in the right way. So what areas outside of what we've already talked about are interesting? Japan has really been fascinating for us to observe this year. We're starting to see green shoots for jobs, for income, for consumption, all improving in Japan. And that recent decision by the Bank of Japan to keep rates unchanged, we don't think that spells the end of kind of normalization in Japan. That country has done such an interesting job of continuing on its own path in 2024, moving to raise rates, really exiting that decade plus of negative rate policy during a time when a lot of major developed central banks were cutting rates. So we've seen the benefits of the policy moves that Japan has been making, and we continue to emphasize that investors should have exposure to the Japanese market, overweight in Japan relative to whatever their benchmark is, and we think that that's a really that could be a great model, on a larger scale for how China eventually gets itself out of the predicament that it's currently in.
Terry, what is interesting in Japan? We have the likes of Goldman saying that given where the yen is in particular, Japan is actually in a very sweet spot for investors to be buying into Japan.
I mean, we think that just buying, general Japanese exposure, the way that we have exposure right now is through an ETF with the ticker EWJ. It just broadly mirrors the Japanese stock market. And we think that that's a great way to just kind of get started with a 5 to 8% exposure in your portfolio to Japan, and to continue to participate in what is really a great turnaround story in that country. So that's how we've been participating thus far.
And Paul, it is about the BOJ in 2025, that rate hike, when it's coming, some say in February. I mean, what are you hearing? Yeah,
well, the market's been ebbing and flowing on where those expectations are going to land. At the moment, we're having another think about January after the accounts of the most recent policy meeting. January's on the cards. What they've been saying to us is we want to have more confidence in the idea that inflation is entrenched, the wage growth is going to continue at a decent pace, that we're not going to slip back into this kind of funk of disinflation and low growth again. So in order to get that, they need to get some more wage data. And so that's one of the things that the market is expecting they'll wait for before they move, which could see towards the end of the first quarter rather than at the start of the first quarter as a more likely time to move. In the meantime, they might also want to wait for Trump and see what happens with the currency markets at the start of it. A much stronger dollar at the start of the year probably means a much weaker yen. Yes, it means great for equity markets in Japan, but they don't want the currency to depreciate too quickly because that could cause its own problems. I think they'll want to monitor that very carefully, and the Japanese government will want to sit on the currency if it does start to move and turn into a very one-sided move. But that will also open the door even wider for them to go ahead and make that hike when the time is right. It feels like equity market has some momentum. Currency is already very weak. It doesn't matter if it gets a little bit of a boost from higher interest rates. We've got bond yields anticipating that there's going to be a move at some point as well. So in some ways, I feel like BOJ better, just get on with it and stop sitting on the fence on this one.
Let's wait and see. Still, is it Jan? Is it Feb? Terry, before we let you go, as we sit on the cusp of 2025, I'm just wondering what you deem as the biggest risk for markets. I mean, there's been so much uncertainty. We talk about how we're waiting to see what Trump's policies will look like. We're talking about how, there's uncertainty in China, for instance, where the path is for growth there. What is the biggest risk for you in 2025?
Yeah, thank you for asking. I think that what you've touched on are a lot of the things that we do like. We do like U.S. stocks. We do have a pretty good idea as to what Trump's policies are going to be like coming in. We think that there's great opportunities in energy names in the U.S., in Japan, internationally. If there's one thing, though, that we do think is being underestimated, it's the risk of recession in the United States in 2025. We think it's a low probability, but we don't think it's a zero probability. And we don't hear enough people, I think, worrying about it and the risks and making sure that they've got some guardrails in place in case we do see that here in the United States.
Terry, thank you so much for your time today, and Happy New Year. Have a fantastic 2025. Terri Spath of Zuma Wealth and our very own Bloomberg's Paul Dobson. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Now, India's currency strategy is in focus after the rupee fell to record lows last week. Volatility also spiked. Speculation is growing that the RBI might be easing its tight grip on the currency amid a strong dollar. Avril Hong is here with a closer look. And you know what, Avril? Given the weakness in the currency, Indian stocks are a very hot sell.
Yeah, but we've seen those valuation concerns of late and how the growth shocks to the downside have really caused investors to rethink India equities, but let's focus on what we're seeing on the rupee, because the implied volatility based on 1 month, that's actually spiked to the highest level we've seen it since August last year. Compare this to just a couple of months ago, where in August it was at record low. So that's part of what's spurring speculation that the RBI is shifting its currency strategy, maybe allowing for more volatility. We have the likes of Mitchell Kotecha of Barclays saying that there are risks associated with low volatility. Think about complacency among domestic currency hedging, and capping volatility in the near term might also mean eventually we see large moves, something the RBI would be keen not to see. So among the factors that are spurring that speculation that the RBI is maybe allowing a bit more volatility. But let's also check in on how the rupee is trading here and now, because as you know, last week we did hit a record low against the greenback. It looks like it's gone past the lows of last Friday. 85.54 was where it was sitting just a couple days back, and it's seen even more weakness seeping in. Of course, the rupee is among the currencies that have been edging lower against the dollar this quarter. You think about Trump winning the presidency, but also how the Fed has signaled fewer rate cuts going forward. Of course, it's also about the domestic picture. As I mentioned a short while ago, that big shocker, domestic growth has been slowing, and we're also seeing these global headwinds that could weigh on the currency going forward, Has.
And add to that, April, we have foreign funds making exit from Indian stocks. That's weighing on the currency as well. Avril Hong, thank you so much for that. Let's get more on the outlook for India in 2025. Madhavi Arora is Chief Economist at Emkay Global Financial Services. Madhavi, good to have you with us. We've been talking about the Indian rupee. You got to imagine that, you know what, with expectations that the dollar will remain strong in 2025, that rupee may be under pressure.
Hi, Haslinda. Well, you're correct. Asian currencies have been under pressure for the last 1 quarter, largely led by 2 or 3 factors. One is, of course, the Trump win, which sort of brings back the tariff issues back in order. Second is U.S. exceptionalism, which has worked very well for the U.S. economy and the U.S. asset classes in general. And third, of course, the fact that, there's any which way the trade war, which is brewing between U.S. and China, which is sort of pressurizing Chinese currency in one way or the other, which again implies that Asian trade partners of China will have to align to Chinese currency in some form or the other. Interestingly, rupee actually has done very well in the last quarter, given the fact that we were seeing massive outflows from FPI's equities front, and we also had a current account pressure with regard to higher trade deficit. Despite that, rupee actually has appreciated against CNY by almost 2% in this quarter. So clearly there was the invisible hand of Reserve Bank of India, which was sort of helping the rupee stay afloat, despite the fact that there was a disproportionate pressure that we saw on the currency.
Given where the rupee is right now, is there a sense perhaps that, there'll be increasing costs for the RBI to bear when it comes to FX intervention? How concerned are you about that?
Oh, clearly, I think that's one problem the RBI has been sort of contending with. For that matter, I think the fact that they have to really manage the liquidity back home, they had to intervene beyond the onshore forward market to NDF market, the non-deliverable forward markets in the offshore territory, clearly shows that RBI was really concerned about how to really take care of the trilemma, which basically implies that whether they should manage their own domestic cost of intervention, the policy stance, or rather take care of the rupee in some form or the other. So I think that's pretty much a concern for the RBI for this in the last 2 or 3 months. In fact, this is going to be the biggest concern for the Reserve Bank as we get into next year. And I have a sense that there will be more judicious intervention after having seen massive intervention by the RBI in the last 6 to 9 months. So they really literally killed the volatility in the rupee market for the last 2 years. They didn't let rupee appreciate when we were seeing massive inflows. They didn't let rupee depreciate when we were seeing disproportionate natural weakness for the rupee, which could have actually helped us see some kind of imbalances taken care of. So I think now as we get into the next year, and there could be a massive pressure on Asian currencies led by CNY, I think policymakers would get a little more judicious with regard to their intervention, because it's going to be a lost battle. If you continue to really keep the rupee an outlier in the system, I think it would somewhere cost them, not only just in terms of their own balance sheet, but in terms of the economic order of the system as well.
What rupee level are you looking at in 2025, bearing in mind that there are expectations that, the RBI will make a move this time round under a new governor?
I think it'll be very interesting. FX is one asset class which nobody can really get it right, to be very honest. When it really moves, you don't know where it really ends. So I think once it starts falling, you don't know where it would find its place. But I think as of now, we're looking at, rupee sort of crossing 86.25 by March end, followed by some stability, assuming that large part of the dollar movement would be done by March of next year. So we'll see how it pans out. But I'm pretty sure that FX war would be the next big thing to watch out for the central banks across the world. And RBI would, obviously not be spared from that.
Does the rupee reflect fundamentals, given that the economy has been weakening? Third quarter GDP was really a shocker for a lot of people, prompting the RBI itself to relook at its own estimates.
As I said, last quarter, INR was, one of the best performing Asian currencies, right? We actually appreciated against China, where we have a 40% bilateral trade deficit. So clearly, the rupee somewhere or the other would have, we get the data with a lag, but I'm pretty sure that the REER, which is where the valuation comes into picture, would have been at least 67 percentage point overvalued compared to the fair value that, we've seen over the last decade or so. So I think consistent RBI intervention has somewhere led to rupee being an overappreciated currency, where it should have been ideally been probably somewhere in the middle of the emerging market pact. So I think that's why I'm saying the next quarter or next year, probably you will see the RBI being more judicious and let the rupee find its own fair value. As of now, I think it's around 6 to 7% overvalued.
Madhavi, I'm just wondering how you're assessing the Indian economy. Some say that the drop we saw in growth in the third quarter is actually more concerning than meets the eye, and that if you don't get private consumption, private investment, urban consumption to tick up, then the economy is in deeper trouble.
You're right. FY25 actually was characterized by consistent underwhelming of growth, and we had seen mostly surprises on the upside since COVID on India. Core GVA, which is basically excluding agriculture and government administration and subsidies, which is a better representative of the underlying private sector business cycle, has consistently slowed since the peak, which we saw in 2023. And as of now, it's tracking around 5.3%, which is the lowest in 7 quarters. I think as we move into the next quarters, we will see some improvement. But my sense is that given the fact that we've been really seeing absence of private agents, be it consumption-led or be it investment-led, we're likely going to be seeing a very U-shaped recovery for India rather than a V-shaped one. So probably the next year itself would be very sideways on growth. If we see a 6% growth in FY25, maybe FY26 will be somewhere close to 6.2, 6.3%, not more than that. I think the lack of participation of the urban middle class has been a big turning around as far as the consumption is concerned. And rural, while it is picking up, still I don't think it's really showing signs of a secular uptick for me. So I think private consumption is a big problem. And if private consumption doesn't really pick up in a secular fashion, you will not see private investment really come with a force. So I think the absence of private economic agents will be a story for the next year as well.
Was Governor Shaktikanta Das right in keeping rates on hold for 18 months in a row?
See, we are emerging economies in the end, right? So we tend to sort of do not have that kind of a free degree of freedom with regard to policy rates. It's easy to criticize the governor who's already left the system, but I personally believe that, he had a lot of things to take care of rather than just the interest rate regime. Probably the regulatory regime could have been relatively less tighter, but we'll see how it really plays out because we are seeing delinquencies also, now emerging. So we don't really know whether the policymakers went too far, but definitely both on the fiscal and monetary front, there was a bit of a tightness which could have been avoided. It's not just the monetary side, it's the fiscal side as well, which did not play its part the way it should have.
We've been talking about Trump's policies. Some say that in 2025, when Trump weighs on China's economy, India stands to gain. India could perhaps cement its role, its position in the global supply chain. Might that actually be a positive surprise for India's economy?
we'll see how it really plays out. Look, we've already seen this story play out in 2017-18. China plus one did not really gain India, in a material fashion. We do not have the same competitive advantage as China has. Our export products in the global markets do not match up to that of China. We are largely a raw material exporter, while China is a finished good or intermediary goods exporter. So we don't really have the same competitive edge as of China. And I don't think that assuming that we're going to win this, win out of this trade war in a way that disproportionately gains India is something which I'm not really seeing that really play out in the near term, at least. On the other hand, the bigger fear is that if the trade war.
Madhavi, thank you so much for your time. Madhavi Arora, Emkay Global Financial Services Chief Economist. We thank you so much for your time and Happy New Year. Still to come, South Korea issues an arrest warrant for President Yoon Suk-yeol. We track the latest on Seoul's political crisis next. Keep it here with us. This is Bloomberg. Welcome back. We're counting down to the India Open. By the way, the Nifty, one of the key markets and assets that hit a record high this year, joining the U.S. benchmarks and the Max 7, as well as gold and Bitcoin. Global interest in Indian stocks plus growing shift to equities from domestic retail investors all help lift that sentiment. Bear in mind, though, we've since seen a correction. We've seen how those foreign funds have been making an exit, preferring instead to take money back into the U.S. market. That story of U.S. exceptionalism, pulling money back from the likes of the U.S. as well as China. India, of course, we're counting down to that India Open, a market that's been driven by retail investors, that IPO story this year. Not one to remember, we've seen how all those IPOs have given up most of their gains for the year. India now joining in the final trading day of the year in negative territory. We had the Sensex down 0.4% losses for the other benchmarks, including the Nifty Bank Index as well as the Nifty 100. In terms of the rupee versus the USD, we have weakness in the Indian currency. 85.60 is what we're looking at, in line pretty much with the rest of the Asian currencies. We're also doing a check on Adani stocks at this point in time. Adani planning a $2 billion exit from consumer joint venture with Wilmar. Adani under pressure at this point in time. Adani Enterprises down about 1% as we speak. Losses too for Adani Power, Adani Green Energy, Adani Ports though in reversal, currently up by 0.2%. Of course, it is about Adani planning that $2 billion exit from its India venture with Wilmar. Some say it is about consolidation. Let's get to our Bloomberg conglomerates reporter, PR Sanjay, who has details for us in Mumbai. Sanjay, what's happening there? Why the withdrawal from Wilmar?
The Adani Group will exit from Mumbai-listed Adani Wilmar Limited. This will be a two-phase deal. And this is a kind of a reiteration that Adani Group's flagship, Adani Enterprises Limited, is turning its focus to core infrastructure business rather than spreading too thin. And it has entered into an agreement in which Wilmar will acquire Adani's 31.06% shares in the joint venture. And both parties have agreed that Adani Enterprise will sell its 13% shares in Adani Wilmar to achieve the compliance with minimum public shareholding requirements. And Adani flagship Adani Enterprises will raise over $2 billion from this overall transaction, which includes two steps, which is OFS and sale to Wilmar, offer for sale and sale to Wilmar. This transaction is expected to consummate before 31st March 2025. And this $2 billion shall be utilized to invest in core infrastructure business and renewable business. That is the answer to your question, where because they are now sharpening their focus to invest into core infrastructure business, and they want to be a top three, even if they are in any business. If they are in port business, they want to be in top three. If they are into cement business, they want to top three, and they don't want to spread too thin. So they want to sharpen the focus into investing in core infrastructure business. Hence, they are exiting from Adani Wilmar Limited at this point of time.
So, Sanjay, it is about shedding its non-core businesses. I'm just wondering what's been the reaction in the market. If you take a look at the initial reaction in the markets right now, we're seeing Adani stocks all in losses.
To be very sure, this exit was always on the cards. Since 2022, they were mulling this kind of exit, and then Hindenburg research hit them, and the sale got delayed. And now, when they were about to restart the process, Department of Justice, U.S. Department of Justice allegation hit them hard, and they delayed the process. Now they're restarting the process. The market has already calculated. Market has already absorbed this news long back, and with this, Adani Enterprises has already raised $500 million in October 2024, and with this, AL would have raised now at least $2.5 billion with this transaction, which will be completed by March 2025.
Adani remains on our headlines. We have a story talking about how Adani Green CEO is stepping down. Take us through what is happening there.
So the CEO has been named in this allegation by the DOJ. Now, but the group has reiterated that he's not getting out of Adani Group. He will be given a new role, and he was very instrumental in setting up this Adani Green Energy and setting Kavda, the solar park, etc. So he'll be given a new role, and they're still sticking with Amit Singh. They are holding tight, and they will be giving a new large role. That's what we are picking from the sources from the company.
Is there a sense on whether or not investor sentiment will reverse with this change of leadership?
This is a kind of with two things coming. One is like a change in the leadership that will definitely have an impact, because there was a key managerial person who had been instrumental in setting up this business into the in a bigger shape. He had increased the landscape and scope of the business to unimaginable pace, and that will definitely have an impact. But we'll have to wait and watch what is the new role he will be getting, and what is the kind of a direction that the management is giving to Amit Singh as well. And but at the same time, investors are very upbeat, because they were thinking that they will be going to the capital market regulator and will be asking for more time for this exit. But it has happened. They made a statement yesterday in unexpected way that there will be a two-phased transaction that will fetch them $2 billion, which will be used for the further growth for the company. That is positive news for the company as well.
Adani Green down about 1% on the year. It is up 1%. Bloomberg's PR Sanjay from Mumbai, we thank you so much for your time today. Now to Korea. Lawyers for South Korea's impeached President Yoon Suk-yeol say a warrant issued for his arrest is illegal. The warrant came after Yoon repeatedly defied investigators' requests to face questions over his martial law declaration earlier this month. Bloomberg senior editor Bill Farris is with us right now. Bill, I mean, this is unprecedented. It's never been done before. This is the first South Korean president who's been in the situation.
We're really in uncharted territory. We've been in uncharted territory for more than 2 weeks, ever since President Yoon had that brief declaration of martial law. South Korea is now technically on its third leader in less than a month, with the finance minister as acting President Choi now also operating as finance minister, also helping oversee the investigation into this airline crash, helping manage the economy. There's a lot going on, but this latest arrest warrant is taking us further into unknown territory at this point. Normally, investigators have up to a week to make an arrest. They have not scheduled anything yet. We don't know what the timeline is for this warrant, and we don't know what will happen if investigators or police actually try to carry it out. Previous attempts to look inside the president's office to investigate there were blocked by President Yoon's office. So it remains to be seen how this will play out in the coming hours, the coming days.
So we don't know a lot of things. Do we know whether this is legal?
There are dueling interpretations over this now, as you've heard from President Yoon's team saying that this is an illegal warrant. He continues to say that his declaration of martial law was a legal action empowered to him by holding the presidency. We know that there will be a court hearing expected on January 3rd, but the full process over whether he can return to office fully empowered, or whether he'll be removed from office could take us all the way into June. So we have likely weeks, if not months, of uncertainty ahead of us in terms of South Korea's political landscape.
As you said, he said he will fight in court, and that's coming up on the 3rd of Jan. Do we know what might transpire? How might this play out?
Well, no one expected us to be in this position to begin with, even a week ago, let alone at the start of the month. The big fight is really going to be over the top court and whether the opposition can get 3 additional judges appointed to that panel. It's supposed to have 9 sitting members. It currently has 6. That court will have a huge role in determining whether Yoon's impeachment continues and whether he gets removed from office. The big fight really is over whether they can start to meet and discuss this with just 6 judges in place. So the opposition had set a goal of today being the deadline to have those 3 judges named. Yoon and his party have fought that, and so far they have won on that front. But that may ultimately decide his fate, whether they get those additional judges.
It's pretty chaotic for Korea and the Korean economy. It's all happening at a time when, we saw that Jeju Air coming down on Sunday as well. You got to question what kind of implications they are for Korea as a whole.
There's a real question about how much can be managed at one time. You have, as we were saying, the third head of South Korea this month. He's the finance minister. He's overseeing now this investigation into the airline crash. He's also overseeing the economy still at a time when inflation has picked up above expectations in December. And the won is now the worst performing major currency in the world. It is a lot to handle, and it's not clear that how well South Korea's political system is going to be able to manage this.
All right, Bill, thank you so much for that. Bloomberg's Bill Faris from Singapore. Let's take a look at how markets are faring before we say goodbye to 2024. Let's take a look at where the MSCI Asia Pac Index is at this point in time. We know that it's been under pressure this morning. They are currently in negative territory, given where the benchmarks in New Zealand, Australia, and Taiwan are at this point in time. Bear in mind as well that it is a pretty muted session, given that volumes are really, really low. In terms of the AVEX space, well, the strong dollar story has been dominating in 2024, but the Hong Kong dollar managing to be flat at this point in time, along with the Philippine peso and the Japanese yen. The yen, 156.46. Some say it could get to 160 next year. Well, before we go, here's a look at our guests for the rest of the week. We'll kick off the new year with the Bank of Singapore's global CIO, Jin Chia. And stay with us as we delve into U.S. monetary policy and the threat of bond vigilantes with Ed Yardeni. That's Friday. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.